Last lesson, we learned about what is, value in use, which is also called economic value. We talked about fair value less cost to sell, and we said that higher of these two amounts is called recoverable amount. And if your net book value is greater than recoverable amount, in that case, you say that impairment has happened. We say that if your net book value, which means the value on the balance sheet, is greater than recoverable amount, so we say that impairment has taken place. And we discussed in last session that your IAS 16 PPE impairment can happen, IAS 40 investment property impairment can happen, and we discussed the treatment. Now, we'll go back to those double entries and impairment treatment once more today. But before that, we need to understand which we call impairment indicators. So this lecture is about the indicators. We say that an entity should consider whether there are indications that an asset might have been impaired at the end of each reporting period. So we are now talking about your significant assets, material assets, and we are thinking about that we should consider if the asset has impaired or not. So what are the signs? How do we know that an asset has impaired? So what are the signs of that? We call them impairment indicators, and there could be some external factors. And it's very important to understand. We'll do them one by one. So the topic is impairment indicators, and we talk about external factors first. So indicators that an asset value has declined during the period significantly. Now, what is significantly? You have to make the judgment. IFRS does not tell you that 10,000 fall in the value, 10,000 is significant or 100,000 is significant. It depends on the asset. It depends on how to say the materiality of that thing. So the first indicator is that the entity indicators that an asset value has declined during the period significantly more than would have been expected due to the passage of time or normal use. One is that as the asset is becoming older, with the passage of time, the asset value goes down. Significant changes with an adverse effect on the entity in the technological, market, economic, or legal environment in which the entity operates. So it is possible that the technology which you are using, so you are, for example, a manufacturer of some product which uses certain technology, and that technology is being abandoned. It could be becoming abandoned because of some new technology coming in, or it might be becoming abandoned because of some legal environment. So I'll give you both examples. Like technology becoming older, for example, you talk about DVD manufacturing. So you invested in a plant. The plant had 10 years life, and you thought that you would be manufacturing DVDs, and you would be getting benefits for the next 10 years. So you had a plan, okay, that this is the cash flows which I'm going to collect, and the present value of these cash flows was becoming the recoverable amount. And then suddenly you realize that DVDs are no longer being, because of this change in the IT and technological thing, we may not be able to continue the production of DVD for the next 10 years. We will only be making it for the next 4 years, for example. And then these last year's cash flows are canceled out. So suddenly your economic value, your present value goes down. It goes down means your maybe recoverable amount goes down. So this is an example where you can say that an asset which had certain value, its recoverable amount becomes less because of changes in technology. It could be because of legal requirements. Legal requirements, I'll give you 2 examples. Like you produce motor vehicles of certain, carbon grading of diesel, and then your primary market is Europe, and then in Europe there are new standards, Euro 4 or Euro 5 standards come in, and you know that these diesel engine vehicles or diesel engine generators, they are not allowed, or they will not be allowed after next 2 years. So you have to immediately understand that your recoverable amount of this manufacturing plant has gone down, not because of some technological changes, but because of the legal requirement. There is another thing which became abandoned a few years ago in most of the countries in the world, and that is called asbestos sheet. Asbestos sheet is a lot in many countries for temporary roofing. People, they put a sheet which is like this, asbestos we used to call it. So it was a wavy type of sheet. It looked like that it was made of cement, but it had many other components other than cement. The technology is called, material is called asbestos, and this causes cancer. And this type of roofing or this temporary roofing sheets, they were like abandoned. So legally they were abandoned. So it is possible that one is, in point number 1, we say that your asset has become old. Number 2, asset has not become old, but there are some other market conditions which are decreasing the capacity of this asset. Increased market interest rate or other market rates of return affecting discount rates and therefore reducing the value in use. Now, reducing the value in use. Market interest rates, they also impact your recoverable amount. For example, I need to speak a little bit more detail on this thing. Probably in a few minutes I will do. If you remember, we said that we have this economic value, we will see 5,000, 5,000, and 5,000. We were discussing this example, and we said that let's discount them, and the present values we just assumed to be 4,700, 4,300, and 4,000. We just assumed. Let's suppose that we discounted them at 10%. Now, what is 10%? I'll discuss it later, a little bit later, but in today's lesson. We discounted that at 10% and the present value was 13,000. If you discount this, the same cash flows are same, but you discount it at 12%, these values will go down. These values will decrease and it will not be 13,000, it might be 12,500. So you should remember that as interest rates, they go up, the present value go down. Now, why interest rate goes up and what is the relationship between interest rate and this? What is the discounting process? I'm going to discuss it in detail today, but not within this thing. I'll keep it separate so that we don't mix it up. What you need to remember is that as your interest rates, they go up, the present value goes down. And if the present value is going down, it means your recoverable amount is going down. And there is a possibility that there is impairment. And the carrying amount of entities' net assets exceed the market capitalization. Net assets exceed the market capitalization. What is market capitalization? Who can tell me? What is market capitalization? Yeah, anybody?
I think it is the total number of shares issued in the market multiplied by the present market value.
Perfect. Let's suppose that this is your balance sheet, okay? And I say that company has, 1 million shares with face value of $1. This is face value of $1. Market value of shares is $4, let's suppose, or $3. So when you are making your balance sheet statement of financial position, what happens that here you've got your equity portion. And now I'm going to explain a little bit in more detail, and it is going to be a very interesting thing, by the way. So you've got equity portion, which has share capital, which has share premium, which has retained earnings, and it has reserves. After that, you have non-current liability. Then you have your current liabilities. And here, let me put here your, PPE. I'll put intangibles. I will put investments. I will put, and then I will say non-current assets. Okay. So share capital is going to be 1 million. This is what they tell us, that a company has 1 million shares at $1. So I'm just considering it 1 million. So you can assume that there are 3 zeros on the top. Okay. So it is 1 million. Share premium probably is 300,000. Retained earnings maybe, I don't know, 400,000. Reserves are 200,000. Non-current liabilities 300. This is 150, and this is your total equity and liability. So your total equity and liability is 12350. You've got PPE, which are 2 million. Intangibles are 500. Investments are 500, and these are current assets. Current assets are 300, and balance sheet does not look very good. I will change a few numbers. So I'll make this as 500, and I'll make this as 1,000 and 300. So now balance sheet, two sides are equal. Now, if I ask you, what is equity? How much is equity? So you would say that this part is equity, okay? This part is your equity. And equity is actually the money which belongs to the owners of the business. Because the business has total assets of 2350. They will sell off 2350 assets. They will pay these liabilities. They will pay this liability. And they can take this money, distribute or divide among the shareholders. So if I say what is equity? So equity of this company is 1,900, which means that this business, now the book value of the equity shareholders' wealth, the wealth of the equity shareholders, the wealth of the owners, according to the balance sheet, is 1,900. And if I say net assets, what are net assets? So net assets again means total assets minus total liabilities. So how much are total assets? 2350. Total liabilities are, minus 300, minus 150. So if I put it here, it gives me again 1900. So if I ask you what are the total assets, answer is 1900. So you can consider that it means that what I'm trying to say, that equity is equal to net assets. Equity and net assets are the same thing. Okay, now the question says, now if you consider now this thing, now if I ask you that this is what the balance sheet tells us. Now imagine that at this particular day, market price of share is, like we said, $3. And number of shares, how much are number of shares? Number of shares are 1 million. So we can say that market capitalization is 3 million. Market capitalization is 3 million. Now, see here, you've got market capitalization of 3 million, whereas the net assets, according to the balance sheet, are just 1.9 million. It means that according to the balance sheet, the value of the company is 1.9. But this is according to the balance sheet. There must be some goodwill, some brand value, or some other factors. So if you want to buy this entire company in the market, how can you buy this company? You will have to, Safiola, your camera is on. You need to turn on your camera, turn off, yeah. So if you want to purchase this company, what is the way? You cannot go and buy a company, okay, I'll buy your tables, I'll buy your chairs, I'll buy your building. No. How do you acquire a company? You buy its shares. And if you want to buy the shares of this company, you have to pay 3 million. So in market, you have to pay 3 million to get something for 1.9 million. And that looks perfectly normal. This is exactly how it happens. Balance sheet values are always less. Market values are higher. So if I want to acquire the company, it is for 3 million. But if at some point in time, let's suppose that these numbers do not remain like this. This becomes 1.8, or let me call it 1.5. Now, if I say that the market price of the share has gone down to 1.5 and there are 1 million shares, so it means I can buy this entire company by giving 1.5 million. So if I have $1.5 million, I will buy all the shares of this company from the market. Now, the balance sheet shows 1.9. The market shows 1.5. Imagine the asset. How did you measure the asset? You said that. How did you find out the impairment? You said that on my books, the asset is 600. In the market, the asset is 500. Market value is less, so there is an impairment. The same concept is happening here. That this entity, actually, there is some impairment, because what it looks like that this 1900, it has come out as a result of these numbers. Maybe some of these numbers are overstated. So there is some assets we need to impair, because in the market, it is only for 1.5 million, whereas it shows 1.9. So there is a 400K of impairment we need to record. So there is a 400K of impairment which has happened. The rule is that we need to subtract somehow. I will discuss how do we subtract. We need to subtract these impairment amounts from here on proportion method. Proportion method. By the way, are we clear until here? Yeah.
Yes, sir.
Okay. Yes, sir. Now, I'll continue. I'll take this opportunity to explain this 400 we have to subtract. So I'll discuss it slightly here, and then we'll discuss it in more detail when we do questions. So the question is that in this balance sheet, some of the assets have lost value, and that's why this 1900 is more. It should be 1500. How do I make it 1500? I cannot play with the non-current liabilities or current liabilities. The only way is that I need to decrease the value of some of the assets. And the rule is that let's suppose that there was goodwill also. And let me remove this thing. Okay, I'll take it like this. Instead of investment, I use the word goodwill. And then I have current assets 500. So I need to somehow decrease 400. But let's make it like this. Goodwill, I'll make it for 200. And this I make 1200 or 1150. Yeah. Now I need to decrease the asset side. What we need to do, this asset side we need to decrease by 400. And then from this thing, retained earnings, we need to decrease by 400. So that two sides will become equal. When I will make this 400 drop, then you will definitely get this number 1500. Let me first show you, and then we will discuss. Let's suppose that I decrease 400 from here, okay? Let's suppose that. I say it is not 1150. Let's suppose that I make it 400. And then I make this 0. Now you see that if it has become 1500. This actually is the same. It has now become 1500, which is equal to the market capitalization. So the concept is the same, that the company's net assets cannot be stated higher than the market capitalization. Just like I said that an asset book value cannot be shown higher than the recoverable amount. So this is for the company, the recoverable amount is market capitalization. For individual asset, recoverable amount we learned in the previous chapter. For a company, recoverable amount is selling the shares. I mean, if you have to recover money from the company, what do? You sell all of the shares. The recoverable amount of the company is 1500, and it should not be more than that. So we decreased it. Now here, I just decreased it, all of that from here, which is not the proper way. The rule is IAS 36 says that in case of impairment, step number 1 is remove the goodwill. Or step number 1 is again, okay, let me call it remove the goodwill or any identified impaired asset. Because it is possible that sometimes they tell you that there's a difference in the market cap and the net assets, and 400 impairment has happened, and this 400 impairment is because of this fact. Sometimes they tell you that you have a particular asset in your PPE or within your intangible which has lost value. Maybe they tell you in the exam question, or you already know in the real life. If they tell you, first impair that asset. If they do not tell you, then you remove the goodwill. So let me say that I'll just remove it like this. I'll call it reduce the book value of specific impaired asset. This is my first step, because I want to find out that, okay, I need to record 400 impairment. From where should I begin? Which asset? First, I will look for some evidence if any particular asset has been impaired. If not, then remove the entire goodwill. So I did not find any particular asset. There is no sign that one specific asset has been impaired. So next step is you remove the goodwill. In our case, goodwill is 200. So I need to make it 0. So goodwill becomes 0. The first step. If goodwill becomes 0, I have 400 and 200 I already have removed from goodwill. And remaining 200 I need to do. Now, remaining balance, remaining impairment balance should be charged to the non-current assets on proportionate basis. So remaining 200, you should be charging it to the non-current assets on proportionate basis. Proportionate basis. Which are the two non-current assets? I've got this PPE and I've got this intangible. So this impairment, remaining 200 of impairment, because I had to total charge $400, 200 I already reduced from goodwill. The remaining 200 I have to charge to PPE and to intangibles. Usually we do not charge to current assets because within current assets, what do you have? You have receivables, which are separately handled by bad debts, which is a separate case bad debts. Otherwise, we don't reduce receivables. You've got cash, you've got bank, you've got advances, you've got some accrued income, whatever. So you don't reduce them. Yes, there is one item in current asset which is very frequently impaired, and that is called inventory. But for inventory, you have a very specific instruction in exam question that if inventory had been impaired or not, because you cannot assume. Listen, you cannot assume that these current assets have been impaired. Current assets, we usually do not charge impairment unless or until they tell us to do so. If they tell us that inventory has been impaired by 500 or 100, then I will charge. Otherwise, I will not. The general rule is that I've got my PPE and I've got my intangibles. My PPE is 1150, my intangibles are 500, I make a total, it makes me 1650. And I need to charge 200 because total was 400. 200 I already charged to goodwill, remaining 200 I have to charge to these two items. And I will do it on proportionate basis. I'll say that 1150 divided by 1650 times 200. And then I would say 500 divided by 1650 times 200. So I just took like a percentage, a proportion. So this is how I did it. And I'd multiply it with -1. And I would call it multiply -1. So I've charged impairment. And this asset will become now this and this. So if you see that 200 of impairment has been charged, 139, and let me just correct these numbers, I'll just round, ignore this one. So 139 impairment to 1150 and 61 goes here, 200 has been impaired. So goodwill 200 was there, I removed it. This will become, 110. This will become 439. Let me just again, now it is here. And then retained earnings becomes 0 and it becomes now 1500. So you have to make sure that when you start charging impairment, in first case, you go for the goodwill. In the second step, first you go for the specific identified asset. If there is not, remove the goodwill, whatever is remaining, take it on proportionate basis, on percentage basis. That total is 1650. And I have to divide 1650 over these two items. So 200 impairment has to be divided on these two items, which make a total of 1650. The formula which I wrote here was 1150 divided by 1650 times 200. Okay, this is the formula I wrote for here. And for this, I wrote down 500 divided by 1650 times 200. Very simple. Any question you have until here, please ask me. Okay, so I come back to our PowerPoint slide. We said that the carrying amount of the entity's net assets exceed the market capitalization, which means that your book value, like in our case, what happened, that market capitalization was 1500 and carrying amount of the net assets became 1900. So we said that there is a 400 impairment because the balance sheet value of your net assets should not be more than the market capitalization. Now, these are called external sources. You might have some internal sources as well. Internal sources means that, evidence of obsolescence or physical damage, some asset has become too old or it has been physically damaged. So you know that it is impaired. Adverse changes to assets use, usage of asset has changed. Internal evidence that the asset's performance will be worse than expected. It is very common, especially when you purchase some technical assets, there are some type of assets which are very simple, straightforward for you. You buy cars, you buy vehicles, you buy, furniture, equipment. So the usage is very much obvious. You know that how are you going to use this vehicle and what is usually the life of vehicle. These are simple, straightforward assets. Sometimes you purchase assets which are probably unknown to you. Why do I say unknown to you? Maybe you are purchasing that technology or that particular asset for the first time. Or maybe it is a complex asset and you're buying a new brand for the first time. I'll give you two examples here. Back in 2013, we purchased some asset for $9 million. So not big asset, but $9 million. And the technology name, it was called TCC. So this is thermal treatment of some oil cuttings. So TCC was a new technology. It was not new for us. It was new in globally. It was a new technology. And we were investing 9 million on that. So how much life we should be assigning to that asset? Of course, we talk to suppliers. And suppliers, they will tell you many things. But when you start using the assets, then you will start understanding what happened. So expectations cannot be fulfilled. It is also possible that the asset is same, but the brand is new. I again remember I purchased some water jets. And water jets I purchased for a new brand. For a new, it is a water jet. I know what is a water jet. We use it in our business. But I went for a new brand, which was more powerful. But again, the life we had to change, because initially we considered 5 years, but then we reduced it for 3 years because we saw that it's not working as it should be. Sometimes they tell you so many things, like you purchase some, and I'm telling you a real example. So we were using some heavy duty power generator, which was about 2 million USD we paid for only for that power generator. It was a big power generator. And it was a diesel power generator, diesel. We were using diesel in it to, generate power for us offshore, where you don't have electric lines, okay? We saw that the consumption of that was not really very good. And it was like the maintenance cost was going up. So we were facing two problems. Number one, the consumption of diesel was more, and maintenance cost of spare parts and other things are more. And we talked to the supplier that, you told us that this is going to be the consumption, but consumption is more. And he saw that, and he said that, what, the diesel which you are using is of poor quality. The country in which you are, even the water which you use in the production equipment, sometimes you in production process, you have water. And believe you me, the water has got its own pH level. The water has got its own composition. The change in the quality of water can also impact the life of your equipment. And it can impact the output of the product as well as the life of the equipment. So it happens sometimes. And by the way, just for, it might be interesting for you that I had these two devices, two pieces of equipment running parallel side by side. And each equipment is using 300 liters per hour. Imagine 300 liters per hour of diesel. So 300 times 24 hours. So 7,200 liters I need here, and 7,200 liters I need here. So I need 14,400 liters every day, every 24 hours. So 14,000 liters I'm using. And a big oil tanker, which you bring the diesel, that is for 28,000 liters. The big oil tanker is 28,000 liters. So every 2 days, I need this one big tanker, which brings 28,000 liters of fuel. It goes away. You can imagine 300 liters per hour. And 300 here. So every 1 hour, I'm using 600 liters of diesel. So it becomes like for you, for example, when I said that consumption of fuel is going up, fuel consumption increases. So you might be thinking, most people, they use vehicles and other things, and they say, okay, if fuel consumption goes up, what happens? I'm telling you, I'm using 14,400 liters per day. Every 20, this is my daily consumption. And if it goes up a little bit, so it was 300, it goes, and it actually was using 320 or something. Every hour, it was using 20 extra. And times 24, 480 liters this, 480 liters this, 960 liters I'm wasting every 24 hours, multiplied by 365 days in a year. Now you can imagine it is 365,000 or something liters in a year I'm wasting. So I should be very much concerned about this consumption. Anyways, this is a little bit slightly, but when you work at large volume, when you work at large scale, even 1% or 2% sometimes can hit you very bad. So these are my impairment indicators internal. And then we talk about one concept, which is called cash generating unit. And then we'll discuss the impairment of cash generating unit. So cash generating unit, it is a separate part. A separate part means an asset or group of assets. It is a separate part of a business, which could be an asset or a group of assets, for which we can calculate its own cash flows, which has its own cash flows. It has its cash out, it has its cash in. So you can see that how much cash it is generating. We call it cash generating unit, CGU. CGU, cash generating unit, could be one asset, or it could be a group of assets which together generate cash. Generate cash means that cash in they have and cash out they have, and you can find out how much cash I'm getting from this asset. I'll start with very simple example. Let's suppose that you are a transport company and you run buses. So when you run buses or trucks, so this is one bus, and this bus has, 50 seats, 50 passengers. It goes to one city, it comes back from that city. You have 50 tickets, each ticket is for $10, so $500 going up, $500 coming down. It is giving you $1,000 per day cash inflow. Then it has its own expenses. So every day you receive 1,000 and you pay these expenses, the driver, the fuel, the maintenance, the cleaning, and you say, I'm getting $400 per day from this thing. It is my cash generating unit, because I can find out the cash associated with this particular asset. This particular asset cash I can see separately from my entire business. Sometimes it is not one single asset. Sometimes it is a group of assets which together bring cash. For example, you have some production equipment, assembly line, and this cannot work. This can only work with a power generator. So you have a power generator. So you use both of them together, and then you generate cash, because this cannot generate cash on its own and this cannot generate cash on its own. You put it together. For example, if I consider of a cold storage, I call it a cold storage. So there are different types of assets in the cold storage. I've got here refrigerators, I have here building, I have here some forklifters which are used. All of these are assets with different value, but none of them generate cash independently. Together, the building, the refrigerators, and the forklifters, which move the goods, together they call it, cold storage, and together they generate cash. So this is now a group of assets. It is one part of business. So sometimes what happens, what the purpose is that sometimes impairment happens at the asset level. Maybe you find out that, I had a refrigerator which was for 300,000. Now it is only for 200,000. And you know that your refrigerator has impaired. Fine, go decrease the value of refrigerator. But sometimes it's not only about one asset, it's about the entire cold storage unit. That the cold storage unit had a fair value of 1 million in my books, but now it should be reduced down to 0.8 million. So impairment could happen at the asset level, or impairment could happen at the CGU level or at the company level. Okay, I think somebody need to close their mic, please. Now, why I am explaining you this cash generating unit, because in next lesson we are going to do one question from here, where there is an entity ABC. ABC company has a total value of 20 million, and it has 3 cash generating units, let's suppose. Whereas each cash generating unit, it has 6 million, 6 million, and 8 million. And together the company has a value of 20 million. Then suddenly what happens, that this 20 million becomes 18 million or 17 million. So there is a 3 million of impairment at the company level. And that 3 million, we have to somehow distribute to the 3 cash generating units. And then within each cash generating unit, we have to allocate this impairment to individual assets. If there are any goodwills, we will. So first we'll see that this 3 million, how it is going to be distributed between the 3 cash generating units. And then let's suppose that we say that 1 million should be given to it. And if 1 million comes at this level, and probably 0.8 comes here, and maybe I don't know, 1.2 comes here, let's suppose. So if 1 million comes here, then how much should be charged to each asset? So we will do one complex full question in which we will see that the impairment is being charged to individual asset and to the cash generating unit and to the group as a whole. So that's why I discussed this cash generating unit. Are you clear here? So now let me start one more thing. Now we have been discussing this discount rate twice. We discussed it in the previous session and we discussed today as well. Now, like I told you before, that this is your cost of capital, which we need to explain. It is not part of your financial reporting, but let's now discuss what is your discount rate, where it comes from, how do you find it, and what are the implications of your discount rate. So let's do it now.